Everybody, welcome back to Young Entrepreneurs of the World 2023. We've had an exciting day so far with our virtual audience of aspiring young entrepreneurs, and they're hearing from so many leaders in different fields of study on sound business advice. And we are delighted once again to welcome back our good friend, Captain Steve Hoffman from out in the Bay Area here from Founderspace, the CEO. Steve's going to talk to us this afternoon about the golden rules of venture capital. Steve, so good to see you again. Thanks for all your support and for joining us again today.
Glenn, it's fantastic to be here. It's great always to collaborate with you and Stelios.
Well, we welcome you back. Let me hand it off over to you. You've got the floor, and I will see you on the other side.
Okay. Well, today I am going to talk about the golden rules of venture capital. So I'd like to begin with a little about myself so you know who I am. So I am the CEO of Founderspace, and everybody in Silicon Valley calls me Captain Hoff. So if you want to find me online, just search for Captain Hoff. Founderspace is a global startup incubator and accelerator, and I'm also an author. So I've written 3 books on innovation and entrepreneurship: Make Elephants Fly, which is all about the process of radical innovation. That's published by Hachette. Surviving a Startup, which is everything you entrepreneurs need to know to get your companies going. You know, I've done 3 venture funded startups in my career. I've worked with hundreds of startups in Silicon Valley and around the world through Founderspace, accelerating them. All that knowledge is in there. And that's published by HarperCollins. And my 3rd book, The 5 Forces That Change Everything, is about how new emergent technologies are poised to change everything we do, everything in business, government, politics, society, you name it. And these technologies are AI, nanotech, CRISPR gene editing, deep tech like space technologies, and many more. Go into those and show you what's coming in the near future, what's in the lab right now, and how that will leave the lab and actually affect all you entrepreneurs out there. So Founderspace is a global company. We actually operate in over 22 countries. We have 50 different partners, and I spend a lot of my time traveling around the globe, working with entrepreneurs and helping them grow and scale their businesses and access capital. And today we're going to talk about capital. So we're going to talk about the golden rules of venture capital. This is what you need to know as an entrepreneur if you're going to raise venture capital. And I'm sure many of you are thinking that, many of you out there. So the first rule is those who have the gold makes the rules. And this is what venture capitalists love to say, and it's their mindset. They have the money, they make the rules. But honestly, that's a myth. Entrepreneurs have a lot more power than they think they do, even at a very early stage. So I encourage you, when you go to a venture capitalist, don't just accept the first venture capitalist who offers you money or the first angel investor. You need to make sure they are the right partners for your business. Because once you accept them into your company, once you take their money, it's hard to get rid of them. And if their vision is not aligned with your vision, it can cause enormous problems. So always remember, you are the final decision maker. You make the rules. It's your company. You choose who invests and who doesn't. And don't ever think you need somebody's money if your gut feeling says they're not the right partner for you. Herd mentality. I've worked in Silicon Valley for decades, and I will tell you, venture capitalists tend to operate on herd mentality. They are all looking at what other VCs are doing, and they are judging by that. It affects everything. The valuation of your company, what is your company worth? Well, I'll tell you, it's worth what the market thinks it does, and that is based on a psychological perception at any given time by venture capital in a certain geographic location. So if you're in Silicon Valley, all the venture capitalists are seeing all the deals that are coming through, and they're going to be pricing in their head your company. And if you come in way outside that range, like way too high, they're going to decline. If you're way too low, then you're short selling yourself. So you've got to understand how VCs think. The same thing is with technologies. Like the flavor of the day right now is artificial intelligence, generative AI with Chat GPT. Everybody's on top of that. All the deals are focused in that area because that's where the herd has moved. Before it was the metaverse, it was blockchain, cryptocurrency. You go down the line, there's always something happening at any given point in time where the majority of the investment community is really focused on it, and they see that as the next big opportunity. If you're outside of that focus, it's much harder to raise capital. If you're right in line with it, it's much easier. Fund makers. In order to understand how venture capitalists make their decision when investing in you, you need to understand what they're looking for. So you can go to a venture capitalist and you can tell this venture capitalist, I have a great business. It's going to be profitable next year. It'll make money every year. There's no way you could lose money on this business. And they might look at that opportunity and say, we're not interested. You're like, why? Like, this is a great business. And they're not interested, probably because it's the growth of your business is too slow. So venture capitalists have a model, and theirs is a portfolio model, which means they will invest across multiple startups. Usually it's 10 to 20 startups, maybe even more, that they're investing across. And they are hoping that out of those 10 to 20 startups, one of them, just one, becomes what they call a fund maker. A fund maker is a startup that does so well, it pays back the entire fund and more. And usually, if you look at it, look at a typical venture capital firm's investments, one startup will be worth exponentially more than all the others. That single startup will be worth more than all the others combined. That is their fund maker. And so when they are placing a bet, they don't want small bets because those are never going to become fund makers. What they're looking for is that every bet they place, because they're only going to make so many bets, has the potential to be a unicorn, or a decacorn or even bigger. That is what they're looking for. And because they know that one company that does extremely well, they can shovel lots of money into it and it will end up paying back for itself 100 times over. And that will make up for all the losers. So they're not going to invest in just a good business. They need an exponentially great business. That is what their filter is. And if you go to traditional venture capital, like in Silicon Valley, with a business that doesn't fit that model, you're going to the wrong investors. They are not your investors. Peer pressure. I worked inside one of the top VC firms. I won't name the name, in Sand Hill Road. That's where most of the VC firms are in Silicon Valley. And I saw exactly how this firm operated. This firm, I wasn't a partner there. I was actually in a startup. I was running one of my startups, and they actually took us in and incubated us inside their firm, which is not common. It's a privilege you get. And so we were in the firm day to day, looking at everything that goes on and all the decisions they were making. They were calling us in and asking our opinion. Now, what happens in the dynamic in a VC firm when they come to make a decision on a startup? Well, let me tell you, the VCs are often less concerned with the quality of the deal than with how they appear to their peers. People are people, and they're very sensitive to saying something that the group will disagree with. So usually there's a group dynamic there, and sometimes it's good and sometimes it's bad. But a lot of times you will find as an entrepreneur that the top people in the group, unless they're really bold, they won't want to damage their reputation. So they will let junior members of the group take the big risks, come in with the startups that are super risky and champion them, and then they will just go along with the group decision. Now, this means that when you get a champion within a VC firm to actually take you to the whole firm and get their approval, you need somebody who's willing to take risks, who doesn't mind being the one who brought in the bad deal. because if they're afraid of that, they will never stand up and go to bat for you. And let me tell you, a lot of times the best deals that firms approve are not ones where they reach consensus. They aren't ones where everybody agrees. The best deals often tend to be the ones that are so crazy and out there that there's like one or two champions that are just overwhelmingly passionate about them, and the rest of the group gets swayed by that. Those are the deals that usually end up becoming the fund makers. Group decision-making is something you need to understand because it directly affects your ability to get funded. A lot of VC firms, not all of them, but a lot of them in Silicon Valley, if one person strongly objects to the deal, they will not do it. They will pass on a deal. Even if the other 9, let's say there are 10 of them in the firm, other 9 partners say it's a good deal, I'm on board. But one strongly objects. And they do this for a reason. And it's kind of a wimpy reason, but the reason is they want to cover their butts. They don't want that one person coming back and telling them, I told you so, I told you so, that was a bad deal. They want everybody to have bought into the deal in order for them to say yes. So this type of decision making, I've been there pitching my startups to the firms many times, and we'll get approval we'll go through this process, we'll get approval, we'll get a champion, we'll get approval from everybody, but there'll be one naysayer, and that person will shoot down the deal. I actually don't like this system. I think it makes for poor decision making. Yes, it makes for better group dynamics because there isn't a person saying, I told you so, but I think it makes for poor deal decisions. I prefer it when, somebody's super passionate, they champion the deal, and the other people let them run with their bet. They let them run with their hunch because you come in with a lot more diversity in deals that way. How to talk to investors. So there are different types of pitches. If you go to pitch to an entire firm, like I was talking about, you would have a formal presentation, and it's usually 20 minutes or so that you would give to the investors, and then you'd open it up to questions. However, if you meet with investors in smaller groups, like you're meeting with one-on-one with an investor, or you're meeting with 2 investors at a time, do not do your whole PowerPoint pitch. Have a condensed version that you can walk them through. And even as you're walking them through that, start a dialogue. What you really want to do is talk to them. You don't want to just pitch them. Pitching is a one-way communication. You want a 2-way dialogue where you are actually engaging them, where you are opening it up for them to ask questions. You aren't stuck to a standard PowerPoint. You'll deviate if they have a question on a certain topic. You'll go deep on some things that they really want to know about. You want to talk to them as if they were already a partner in your business, and you're trying to figure out, if this business is a really good fit and where this business will go. Getting their advice, walking away with their advice is more valuable than their money. I will tell you, because if you get their advice, that they look at a lot of companies, they can tell you things you think you know that you don't know, things that really surprise you and can fundamentally change your view on your business. They can also, if they're giving you advice and you're going back and forth and you're building a rapport, they are much more likely to invest, because that's what VCs really want. They want to feel part of the business. And the way you feel part of something is when you contribute to it, when you are part of the idea and creation of the business. So the more advice they give you, actually the higher chance you have of getting funded. And the more hard questions they ask you, the higher chance you have of getting funded by them. That means they're engaged. Don't hide anything. This is a fundamental rule. A lot of entrepreneurs will try to hide bad news. They'll try to cover it up. They'll try to only show the rosy picture of their business, all the great things, and not talk about the hard problems. But let me tell you, when I hear an entrepreneur and they come in to pitch me, I invest in a lot of companies. When they come in to pitch me, I am always impressed with the entrepreneurs who will dive into the hard problems and talk about them plainly. These are the problems we face. These are the challenges. This is what I'm doing to overcome those challenges. I'd love to hear from you what you think. That type of disclosure really builds trust. And at the end of the day, there's 2 things that I'm going to make my decision on: the opportunity. How big and how good is the opportunity with this team and this product and everything else? And do I trust them? because if I don't trust them, if I don't think we can really communicate, if I don't think they're going to be honest with me, I know it's going to be a bad investment in the end. So laying all your cards in the table, showing them everything, gives you a much higher probability of building that trust and opening up the type of dialogue you want with your investors moving forward, where they can truly help you because you are truly showing them your business, warts and all. Prepare for due diligence. You know, a lot of entrepreneurs, they're so busy trying to raise money and grow their company and do everything. You know, there's a billion things on their list that they have to do, talk to customers, that they don't prepare their due diligence package. Let me tell you, from before you ever talk to an investor, you should have created a Dropbox folder, and you and every key member, the other co-founders on your team, should put every important document into that folder, a copy of every important document, meaning every contract you sign, all the rights to the IPs, any patents, any trademarks, you know, anything to do with your company and about shares and all of that stuff, ownership, all of that, your cap table, all of that should be in one Dropbox folder. And due diligence is simple. Literally, when an investor says, you know, I need to do my due diligence, you say, let me send you the link. And you literally send them the link to that Dropbox folder, and they have all the information they need to make a decision on investing. This speeds up the process dramatically. What corporate VCs want. So if you're pitching to corporate VCs, it's an entirely different ballgame than pitching to venture firms in Silicon Valley. Corporate VCs tend to make their decision less based on the outcome. They're not looking for a home run outcome. What they're really looking for is, does your company fit strategically with their overall plans? So if your startup and your product or service actually add to their overall ecosystem, where they will further their big corporate goals by investing in you, they are much more likely to invest. So when talking to corporate VCs, you can talk about the upside of the investment and the potential of becoming a unicorn and everything else, but you also really need to focus on, you really need to understand, first of all, what are their objectives for their corporation, and what do they need from you to make that a good fit? If you don't understand that going into a meeting with corporate VCs, then you probably aren't going to get their money, because you probably aren't going to be talking about what they really care about. Don't chase the money. If an investor isn't chasing you, it's not working. So I always like to say, get the investors to chase you. Don't chase them. Because if you're chasing them, like if they're on the fence and they're not deciding and you keep running after them, you're wasting your time. Really good investors, when they see a good deal, they are on it. Literally, they don't waste time. Good deals happen quickly, and bad deals almost never happen. So chasing an investor who's lukewarm on you usually ends up just, it's a waste of your mental energy and a waste of your most valuable asset, which is your time. Friends and family. My rule about friends and family is don't take their money. Honestly, I mean, there are a lot of success stories. People have taken money from friends and family, but there are a lot more horror stories where people have taken money from friends and family and lost their money. And think about it. It's okay if you lose an investor's money, but if you lose your friend's money or your relatives' money, you have to live with those people. Like you can lose those friends, you can damage those relationships. It's not worth it. They don't know what they're investing in. Unless your friend is an experienced VC or angel investor, or your family is, then they don't know what they're investing for. And the last thing you want to do is drive a wedge between you when your company's in trouble and you're failing, and you go to them for sympathy and they're like, well, I just gave you $50,000 that you lost, and that was my retirement money or my kids' college money or some other money that was very important to me to buy a home. Whatever it was, you don't want to be in that position. Look, if you cannot get experienced investors to invest in your company, maybe there's something wrong. Maybe there's something not working. And you shouldn't be going to friends and family at that point. You should be saving up more money, running leaner. That's the better way to bootstrap a company. How angels operate. So angels operate totally different than VCs. Everything I told you about VCs, most of it doesn't apply to angels. They make their decisions. Angels make decisions on all sorts of things. They could like you and make a decision. They could fall in love with your product and make a decision. They could make a decision because they're having a great day. And angels, can be very fickle. Sometimes they'll say yes, sometimes they'll say no. Very much, in some ways, easier and much harder to close angels. The reason it's easier is because there are a lot of angels out there and they don't always look as carefully or understand your business as well as a venture firm will. And a lot of times you don't have to pitch all the partners in a venture firm. You just have one person to close. However, a lot of angels out there, they're not under pressure to give you money, right? VCs are actually under pressure. They have to invest. They have raised capital and they need to put it somewhere. So, and it's not necessarily all their money. It's money from their LPs, from their partners. So they are going to invest. It's a business decision for them. For angels, a lot of times it's a personal decision. A lot of it is about you, their relationship to you, their passion for being involved in a startup. These type of things can outweigh the financials at the end of the day. You need to keep this psychology in mind. Qualify each lead. One of the biggest things I say when you're pitching investors is know if they're legit. Talk to the investor. Ask the investor, how many investments have you made in the past 6 months? If they haven't made any investments in the past 6 months, they're not a real investor. They're probably not going to be investing in you. Walk away. Don't even bother to meet with them. So you get a lot of leads in email and from AngelList and other places. Don't meet with people unless they're serious investors and they're actively investing. Customers are angels. Some of your best customers out there are angel investors. So when you go out there to potential customers, literally, if they're a company that you're working with, they could be a perfect investor for you. Don't overlook them. Are we out of time? I don't want to run too long. I'm almost done.
That wasn't my cough.
Okay, that wasn't your call. Okay. So one more rule for all you entrepreneurs out there is when an investor is on the fence, when they can't make a decision, push them off the fence. Literally, I always like to say, push for a no. Go to that investor, and if they haven't made a decision, like you've met with them 3 or 4 times, they are still undecided, literally say, I've given you everything you need to make a decision. You have to make a decision within the next week or I'm moving on. Literally give them a deadline that will push them off the fence. And if they don't invest you in the next week, I can almost guarantee you they would have never invested in you. You are almost never losing money pushing somebody off the fence. Take the deal. If you have a good deal, even if it's not at the valuation you think the maximum valuation you could get, but you like the investors, the timing is right, take the money. Valuation is not the most important thing. Help each other. Entrepreneurs out there, when you're out there, a lot of times your best source for introductions to new investors is entrepreneurs, other entrepreneurs, because all of you as entrepreneurs are actually meeting with investors. So if you're actively fundraising, you are meeting with investors on a daily or weekly basis, and you should be referring each other to these investors. My last point, always be raising. Even if you've just raised a round, raise more money. Literally, the job of a CEO of a startup is to feed the beast. And your job of raising capital is actually easier after you close a round. So after you close a round, you should start thinking about your next round and your next round. Don't wait 6 months to a year to start raising when you're starting to run low on money, because then you're under a lot of pressure. When you're not under pressure, it's much easier because you're flush with money, your company's growing, you can be talking to investors. And if you find the right investor for the right reason, up the valuation, let them in on the company. So those are my pieces of advice. I hope you enjoyed them. If you want to reach out to me for any reason, just go to founderspace.com, founderspace.com. You can email me directly from the site. You can submit your business plan. We angel invest in lots of startups. We also accelerate lots of startups, and we connect startups with investors. So we're always looking for entrepreneurs who are coming to us with great ideas, great businesses that we can help grow. Thank you so much. I look forward to meeting you all in person someday.
Thank you, Captain Hoff. Excellent as always. 16 solid golden rules of venture capital. That last graphic was a little bit scary with the extra fingers and stuff, but
Oh, yeah.
and hands. Couple quick things. The prepare for due diligence, again, as an accountant, very important. And what you said, I think it's almost empowering when somebody asks for that. It's almost like if you were going through a job search and you didn't have your resume quite ready yet. You're always like, well, you know me, I don't know. But here, when you have it, it's like, here's the link, right?
Exactly.
Here's the data room. Go at it.
Yeah,
I
you
think,
literally send it to them 5 minutes later and
yeah,
they can go at it. And then there's no, a lot of people even ask for the link and they don't spend a lot of time looking at it. So
just the fact that you made it available, right?
yeah, just like here's the due diligence. You got everything you need to make a decision. What you want to do is shorten the process. So having everything prepared so that all their questions, if they need to know it, it's right in the due diligence package. All the deals we signed, just go look them up.
Absolutely. Obviously, you appreciate and your Sunday and Thanksgiving dinners. So your friends and family's advice is
Yeah,
very,
you don't want to go back to
good.
Thanksgiving having lost your Uncle Harry's money.
Yeah, not a
Even
the
though Uncle
table,
Harry seems like a nice guy, he might not be after you
the
lose his
table may
money.
not be big enough to separate you guys, right? So that makes for an interesting point. And then the last piece I had, the peer pressure one was interesting to me. That you're doing the best you can, but sometimes you can't take on other people's feelings. You could be making these presentations and they may take you, they may not take you, and they may not have anything to do with you. It may be the environment they're in and what are some of their other
group decision making is really odd. Like they found doing focus groups for products where people evaluate products that one dominant person could totally sway the group, like positive or negative. Like it's not, people have they're different alpha people in the group and beta people. And you need to understand that there may be a dynamic just because you got brought in by a certain person in the deal. Another person may want to kill it because they don't like that person. And you just get caught in the middle. Yes, you cannot take these things personally.
Yeah. And then your second to last point, and thank you for saying it, because that's a lot about what we're doing here with One Business World. We're all a community. We're all trying to help each other out here. People have lived certain transactions and certain processes, much like yourself. You've seen so much, and being a resource for each other as a community member as we build community here in this entrepreneurial world is so important. So thanks for saying that too, as part of your.
You're welcome. And you guys are doing a great job. I love collaborating.
It's really important for everybody to help each other out. So listen, Captain Hoff, thank you as always. Tremendous afternoon here for us. Wishing you all the best and look forward to seeing you next time.
Thank you. Take care, Glenn.
Take good care. Bye.
Bye.